Welcome to this edition of Infrastructure Investor Briefing focused on the Mexico City Airport project. I am Pablo Lutero, Analytical Manager of the Latin American Infrastructure Practice, and I will be your host. In today's edition, we will focus on the impact of current market volatility on the airport's expected financing plan, its effect on Mexico's credit quality, and finally, the impact over traffic. To discuss these issues, together with me, we have Thomas Jackwood in Sydney, Joydeep Mukherjee in New York, and Jose Kobayashi in Mexico City. S&P Global Ratings assigned a BBB plus issue rating to the $2 billion senior secured debt issued by Mexico City Airport Trust. The rating outlook on the debt is negative. Jose, could you please summarize the structure for us?
The federal government is building the new Mexico City Airport to meet future growth needs. In Phase 1, the new facilities will include one large terminal and 3 runways that will cost around $13 billion, out of which some $6 billion are expected to be raised in the capital markets. Funds will be raised in stages over the next 2 years and will rank pari passu. These financings will be fully guaranteed by all present and future airport charges, known as TUA, from the operations of both the existing and later the new airport. Under the cash waterfall, TUA revenues will first be applied to pay down trust and other expenses, and second, to pay down senior debt service and replenish reserve accounts. Any surplus cash will go to GACM and will be used to cover operating and other corporate costs, including any debt obligations that GACM may have. Our analysis only considers the ability of the existing airport to support debt repayment over time, and we don't incorporate the new airport's potential revenue. As a result, any construction-related risks don't constrain the ratings.
Among events that took place after we issued the rating, one of the most relevant is Donald Trump's victory in the U.S. presidential election. The victory of Mr. Trump caught most observers by surprise, increasing uncertainty over the policy discretion of the U.S., especially regarding trade. Uncertainty regarding the future of NAFTA under Trump's administration has driven a deterioration in investors' sentiment toward Mexico, which has resulted in a significant depreciation of the peso and an increase in interest rate. Thomas, how does current volatility in the markets affect the expected financing plan going forward?
From our perspective, we do not believe the current interest rate environment presents an immediate risk to the airport for 3 specific reasons. The initial issuance of $2 billion, the airport has placed itself in a position that it does not need to immediately tap the market again. This provides flexibility to raise new funds when conditions are favorable. The coupon for the initial $2 billion was well below our expectation, which provides some buffer if future issuances are more expensive. We had assumed increased base rates and margins for future issuances, which, even under the current market environment, we believe the airport can achieve.
How would conditions get worse?
A more severe scenario would be if debt market for emerging market corporates were to dry out entirely, which would put pressure on the company's funding plan for the construction of the new airport. We view this scenario as remote, and even in the unlikely event of it occurring, we believe this would only be temporary.
Thank you, Thomas. Now, turning to Joydeep for a second, what has changed in terms of Mexico's GDP growth and sovereign credit quality?
We have not changed any sovereign ratings or outlooks thus far based on the U.S. election results. Mexico's BBB plus long-term foreign currency sovereign rating reflects many structural features that provide stability to the economy and give scope to policymakers to manage new challenges. The U.S. election results have increased the possibility that Mexico will suffer from persistently low economic growth. Such a scenario would have a negative impact on the sovereign's revenues and make it harder for the government to pursue fiscal policy that gradually stabilizes its steadily rising debt burden.
Could the change in the expectation of the GDP growth affect the likelihood of support to GACM and other GREs in general?
We do not see any potential weakening of the government's likelihood of support for GREs, regardless whether the rating stays at BBB plus or goes down to BBB. The government has taken steps to assist other GREs, such as Pemex, in recent times, and is likely to maintain its support for the new airport investment project.
Thank you, Joydeep. Thomas, what would be the consequences of a lower GDP growth over traffic?
Traffic at Mexico City Airport has remained solid over 2016. Saying that, we have recently revised down our GDP growth expectation for Mexico, remaining at about 2%, or about 70 basis points lower than our prior forecast. Given the correlation between GDP and traffic, we expect passenger traffic growth to moderate in the near future, but believe that traffic will continue to benefit from the Open Sky Agreement between the US and Mexico. Even if this agreement was to be questioned, one of the key factors for our rating analysis is that the existing airport will soon run out of capacity, and from that point, revenue growth would simply reflect increase in tariff and not traffic. Short to medium-term underperformance will simply delay the point at which full capacity is reached. Clearly, the duration and severity of such downturn would need to be taken into account, but absent a long and severe recession, we believe the direct impact of the airport would be limited.
Jose, is recent peso volatility a concern for the transaction?
Currency risk for the airport is limited, primarily because the charges are denominated in US dollars, matching the currency of the debt. Now, a devaluation of the peso means that travel abroad becomes more expensive for Mexican residents, and this could negatively impact outbound travel from the airport. On the other hand, there should be greater inbound traffic as travel to the country becomes more affordable. Also, some of the construction contracts for the new airport will be denominated in pesos, and this could result in a marginal decrease in total construction costs in dollar terms. Overall, any weakness in cash flows derived from currency volatility could lower residual cash flow to GACM. This could lead to higher leverage at GACM and affect our view of its credit quality. This is relevant because its credit quality caps our rating on the airport's debt.
Thank you very much to our analysts. Please check for recent updates at smratings.com/infrastructure. Thanks for watching, and we'll see you the next time.